All right, hello and welcome to another Expert Inside interview. My name is John Golden from SalesPOP, online sales magazine and Pipeliner CRM, joining you as usual from a sunny San Diego. And today I'm delighted to be joined by Brandon Thor, who is the founder and CEO of the Thor Metals Group. How are you doing, Brandon?
I'm great, John. Thanks for having me on.
And what part of the world are you in today, Brandon?
We are in Los Angeles. If you fly into LAX, you will probably skim the roof of our building. So right here.
Excellent, excellent. And Thor Metal Group is one of the fastest growing precious metal dealers in the US. Named Best Gold Dealer by Breitbart, Best Gold IRA Company by Financial Services Review. What we're going to talk about today is a very, very interesting subject. So 1980 to 2000 and 2000 to 2025, two different world growth-based economy, debt-based economy, and for two very different ones, right? But you say a lot of people still applied the same strategies as they did in the 80s and 90s, not realizing the difference between these economies. So maybe just to baseline it, set the scene, like what was happening pre-2000 and what happened post-2000?
Sure. I mean, look, it's a great question to bring up. And, this is what I tell my clients. When you look at 1980 to 2000 and 2000 and now, that's a very good point of demarcation. I mean, it was two different worlds. And so let me just paint a picture. 1981, okay, if you're trying to buy a house, your mortgage was 20%. If you actually had money to put in savings, you were getting 15% on a CD. All right. So that's what interest rates were. Now here's the thing. The 80s and 90s also, we saw the largest workforce in American history, the baby boomers, right? So we had this robust workforce and we had just massive, of course, growth, and when you have a big workforce and an industrious workforce, you have a lot of growth. Now, we also had a lot of power. It was king dollar. So the dollar had a lot of strength. The petrodollar deal was not as much in the rearview mirror as it is today. Right. So, I mean, we're talking a strong dollar, a lot of growth, big workforce, exploding GDP, and also a debt ceiling that we never went above. It was a hot stove, right? It was actually surplus at one point. So that was the economy. It was a growth-based economy. And then, of course, 2000, it changes. Now, 2000, 9/11 hits, the baby boomers start retiring, the biggest exodus in American history. Interest rates that were, darn near 15%, 20% in 1980 are now 0% for over a decade. And a debt ceiling that was at 3 trillion is now 37 trillion and climbing. So we are in a debt-based economy. And so why would you apply the same strategies that you would in a growth-based economy and a debt-based economy? It's like wearing a parka to the beach or swimming trunks in the Arctic. So that's literally where the disconnect is.
Yeah. And what were some of the changes in policy that brought us to this? Because, for a lot of people, obviously growing, a lot of people maybe who are more familiar post 2000, the idea of a 15-20% interest rate sounds crazy to them, particularly when there was there was almost zero. It was nearly free money for a period. But what changed and what were the long-term impacts of those changes?
Yeah, a lot of people have opinions on this, right? There's people that are just getting, and a lot of it is pushing their kind of their political leanings and whatnot. But the bottom line, at least in my opinion, is what changed is our ability to actually handle adversity or handle, organically tough times. Like, markets are cyclical, and that means that there's going to be ebbs and flows. Well, what happened is when the 2000 crash happened with the internet bust and then the '08, the housing bust, we did not let that play out. We did not let that organically play out. Instead, we sought to just cut the bleeding off and by any means necessary, try to, artificially, move the market up or try to get it stimulated. And one of the ways you stimulate a market is you lower interest rates. Well, how does that stimulate the market? Well, makes it easier to get money, right? Makes it easier to borrow, but also it disincentivizes people from putting their money in fixed income or CDs or stuff. So that dual effect is what creates, people piling into the market, and then, of course, you get that stimulated growth.
Yeah, and then I mean, and then if you're still applying the same strategies as you were pre 2000 to your investments, if you're still like stocks and bonds and all of that, what are some of the things that you're missing out on, or what's the outcome of sticking to those investment strategies in a completely different economy?
Yeah, I mean, look at another great question. And let's look at that with what I do. So I sell precious metals. So let's look at
Mhm.
gold. So if you invested in gold in 1980, right, it was about $300 an ounce. You would have punched me in the face in 1999 because it was $298 an ounce. I mean,
Mhm.
it did not move for 20 years, which
Right.
makes sense. It was more
Yeah.
apocalyptic insurance. And why would you want that when you're, when everything's roaring with the economy?
Mhm.
But what you're missing out on, if you put your money in the market, I think you're up. I mean, and this is with markets being at an all-time high, around 90%, something around there. But gold is up 10 to 1 on the market in the last 25 years. So if you switch strategies when you notice that the economy is switching from growth to debt, you did 10x what you're doing in the market.
Right. So how should you restructure your portfolio for a debt-based economy?
Well, here's the thing. The first thing I did, and by the way, a bit about my background. I grew up, not grew up as an investment banker, but that was my job. I got
Mhm.
my MBA and then I worked at a big Wall Street firm as an iBanker. And, gold was seen as a barbaric relic. I didn't really have a lot of, visibility of it.
Mhm.
Once I learned about physical gold, and I'm going to get to your question, is I realized that it's just a form of currency masquerading as an investment. And the reason people think it's an investment is because it's internally valued, whereas the dollar is externally valued, meaning
Mhm.
the way you find the value of the dollar is the price of ketchup going up 30 cents. The way you find the price of gold is it goes up and down per ounce. But here's the thing. So the way I restructured my portfolio was seeing gold the proper way, which as a store of wealth and as a form of currency. And then what I looked at was, all right, well, what are better opportunities in a debt-based economy? Well, in a debt-based economy, you want to protect against the consequences of debt. And the biggest thing is a dollar devaluation. So
Mhm.
physical gold not only pivots you out of a currency that is drastically going down, but it also positions you in something that does behave as an investment as far as it's internally valued.
Yeah. And what do you say to people who say, "Well, gold is so expensive now, maybe I've missed the boat on this?"
This is what I say. I say, listen, if you judge something because of just it's the highest it's ever been, that is a very poor metric in which to judge something because that means that you would have felt you missed the boat on Amazon when it was $42. Because
Right.
at one point that was the highest it's ever been, right?
Yeah.
The way you need to judge something is you need to first understand what drives it, what price it's at, and what the future holds, right? So if you look at gold at where it's priced at, and you understand that what drives gold is what? It's the weakness of the dollar, it's interest rates, it's level of national debt. So the debt is not getting paid down. Interest rates are still, they're manipulatively low. They've been low. And of course, the dollar, we've quadrupled the money supply here. I mean, we are looking at the barrel of a gun, basically, and the only thing that was propping up the dollar, John, was literally the
Mhm.
fact that we were the exclusive petrodollar, and that's gone. Last June, you know that, right? They didn't
Yep.
renew that. So
Mhm.
now you could buy oil and other
Yep.
currencies. And then, of course, the global reserve currency, which now the BRICS countries are coming after. So without
Mhm.
those two privileges, the dollar is like every other currency. And guess what? If any other country went 37 trillion into debt and quadrupled their currency supply, I got news for you. Their currency would go in the toilet.
Yeah, yeah, no, absolutely. What shifts do you see ahead in the global economy and the markets that may have, and what impact may that have? I mean, are we headed in? Is this unsustainable? What the debt economy, is it unsustainable?
Yeah, I mean, listen, the debt that we are in is unsustainable. It is so astronomical that it's become something that's accepted. It's
Mhm.
so out of the realm of reason, you can't conceptualize it, so you accept it. We just, hey, the sun, rose this morning, so another day in America. So that's a problem. That is a major problem, and I think that the administration realizes this. I think a lot of administrations realize this because the way our political system works with the 4-year terms and stuff is such, it doesn't incentivize a
Right.
president to create long-term solutions. It incentivizes short-term legacy, right? And
Mhm.
that's what happened. So when Obama came in after the '08 crash, he could have let the banks that behaved greedily just tear down to the studs and build up a stronger. But he would have been known as the president that presided over the worst economy in American history. So what did
Mhm.
he do? He bailed out the banks. He did, what would be a legacy saving tactic.
Right.
And so basically, because the political climate is like that, and because we can't kick the can anymore, they realize, what do we do? We can't pay down this debt. The only thing we can do is to make the dollar drastically less. Well, if we do that without something else, then people are going to notice that we just have the worst inflation in history. So what I believe they're going to do is, I believe they're going to come after crypto. I believe that crypto act that was just signed is a Trojan horse, and then they're going to issue it or usher in a new digital dollar, a new digital kind of U.S. backed thing. And by doing so, they're going to create an obsolete dollar, which will allow them to control the narrative and renegotiate the debt, or recreate what debt they can to be manageable. That's what I believe is going to happen. But that's one man's opinion.
Yeah, and what impact is that likely to have on regular consumers if that
I
comes
mean,
to
look,
pass?
in the late '70s, believe it or not, the dollar lost 80% of its value. So, I mean, the biggest impact is going to be on retirees and savers, people in annuities, anything that's dollar denominated. Because if you're guaranteed to get $5,000 a month, starting 7 years from now,
Mhm.
and the dollar loses 80% of its value, and 5,000 is worth 500,
Yeah.
well, you're not living that great of a lifestyle. So the impact's going to be pretty much on conservative people, retirees, savers, folks that are in CDs and annuities and things of that nature.
Yeah, and what do you think we've learned any lessons from that transition from when we bailed out the banks, when we did like interest rate cuts and quantitative easing and all these other wonderfully sounding tactics that they use? Have we learned anything? Do you think for the future?
No, and again, a great question, because it literally is why we're in the situation we're in. Because here's the thing: when you don't allow consequences to be felt, organic consequences, then you literally you almost reward greed. And so
Mhm.
when they bailed out the banks, the too big to fail, and all of that, that's created what's happening now. Do you know that the derivatives, all those derivatives that were in the market, there's like 7x the amount of derivatives now. I mean, Wall Street has just gotten more bold and more greedy because of what happened in '08.
Right.
Now they know, hey, look it, they're not going to allow us to fail, and they're acting on that. I mean, you look no further, and I know I don't go down a rabbit hole, but the yen carry trade, right? I mean, that's just Wall Street greed in a freaking bottle right there, and I don't know how much time we have, but that's basically just Wall Street seeing an opportunity, leveraging it 100x, way more than they should, and then a black swan event occurring, and now they're in big trouble there as well.
Yeah, and obviously learned a lot of lessons from the collateralized debt obligations and those other instruments that were so toxic back in around the financial crisis.
Yeah, I mean, listen, it's really funny that Wall Street is always looking at some creative way. So if you don't let the consequences be felt, then it's like playing whack-a-mole, right?
Mhm.
So getting back to the yen carry trade, because now I'll explain it very briefly.
Yeah.
Basically, what they were doing is, because the yen's been at a 0% interest rate for so long, they were just converting yen into Australian dollars, something that had like 4 or 5% interest rate, and then they were just converting back into yen at a 0% interest rate and pocketing the difference. And they're like, well, wow, if we could make $1 million doing this, why don't we just implement a shitload of, excuse me, language, a truckload of leverage, and make $10 billion. That's Wall Street's philosophy. And guess what happens? The black swan event occurs. The Bank of Japan raises interest rates 0.25%. The yen strengthens. So, of course, the conversion rate gets all out of whack. And now they're left in this, horrific situation that, by the way, has not been unwound yet.
Mm. And obviously, like you said, I mean, given the history, the recent history, they'll be bailed out in some way or fashion, or there'll be something done to avoid the consequences.
Oh yeah, I mean, look at, you know, I don't want to come off as go one side of the aisle or another. You can
Sure.
probably guess what side of the aisle I'm on, but it's all setting up for a situation where we're losing control. I mean, they're gaining more and more control over us through our financial, well-being and our financial, fate, and that's really what it is. I mean, you have too many of these bailouts, and it's one bailout too many. And this time, because I believe, it's going to hit everyone's wallet like it always does. Because think about it, this greed always just hits pensions
Mhm.
and
Yeah,
firefighters and teachers. So, this bailout is going to come at the expense of probably people's freedom, not in an overt way, but
sure.
in an indirect way, because they're going to be enslaved by the dealer of sorts that's going to be had after this next crash.
Yeah, and part of the problem, I guess, Brandon, is like both, there's a lot of pressure, isn't it? There's pressure from consumers because they've become addicted to low interest rates. So people are saying like, oh, I can't buy houses or whatever because the rate. So there's pressure coming from that. Then there's the investors, oh, we can't invest, if money's too expensive, we can't invest in all these great startups and all of that kind. So there's a lot of pressure coming from groups to maintain this, even though they don't they don't tend to see what the negative consequences are for themselves, because we live in very, like you said, even with the 4-year terms, we live in a very short term culture anyway.
Oh, absolutely. Listen, I mean, I'm a big history buff,
Mhm.
I know this is campy. That history repeats itself. Everyone says that, but it's damn true.
Mhm.
And it is damn true down to the printing of money. In fact, at the end of days for the Roman Empire, what they were doing is they were diluting the gold and silver in the coins. So that was their form of money printing. So I
Yeah.
mean, look at this stuff. History repeats itself. This stuff has a consequence, and the fact of the matter is that we not only have a short attention span and really no threshold for pain, but
Mhm.
we don't have any threshold for sacrifice. I mean, we have these generations, and I call it like I compare America to like a multi-generational business, right? So
Mhm.
you have Richard who built the business, all right, and that's good. Your Great Depression generation, really hard generation, went through a lot of sacrifice, and then Richard Jr. expanded the business. That's your World War II generation, and then Richard the Third, that's your baby boomer, right? And he wanted to, he maybe modernize the business. He wanted to really impress because he's following his legacy. Then you got good old Dickie Boy, Richard the Fourth. And Dickie Boy, he doesn't care about the business. He's taking private jets to Vegas and just pilfering through the money. That's where we are. We are Dickie Boy of America. I mean, we
Mhm.
literally, all of those generations that have got us to these points of privilege, we are just completely strip mining, everything from reputational currency to I mean, everything. And so that is what I believe is occurring. I think that's a good analogy for what's occurring. And Dickie Boy, just like these multi-generational wealth, that's how they lose it all, is there's that generation that doesn't want to continue to do the right thing.
Yeah, and we obviously, without the consequences, right? Because we didn't really, we haven't suffered the consequences of our actions, and we don't want to suffer the consequences of our actions. So I mean, it's another cultural thing, right? We want to be able to operate without consequence.
Yeah, I mean, John, it's so funny that people think that they made it through. Oh wait, like their fidelity statement being disappointing for 9 months was like
Yeah.
some sacrifice. I didn't see anyone swan diving out of buildings because they had a disappointing Merrill Lynch statement for a
Mhm.
year and a half. I mean, so it's just so funny our idea of even sacrifice and what adversity looks like.
Yeah, no, and absolutely, and if you notice, I mean, we've got interest rates starting to creep down again now, so and like I said, people have been so kind of, um, they've been kind of so addicted to, like, pushed on this concept of cheap money, but it's not. But the thing is, it's not cheap money, is it? Because the money's continuing to lose value.
Yeah, absolutely. I mean, there was a study done on like the different psychological profiles of a market cycle, and right before a crash, it's unabated or unjustified euphoria. I can't remember exactly what the term is, but it's basically when we stop asking why. Right? The market's at an all-time high, but we stop asking why. We
Hmm.
stop like looking at the logic, which is why the hell are stocks trading at 40x earnings? Why the hell is this? So when you stop asking why, that is the most dangerous end of days time that precedes the crash. And that's where I believe we are. Because we literally, I mean, it is insane to me. We dropped a bomb on Iran and the market went up on Monday. I mean, if you're any type of investor, that is like watching a pig fly, and that's what happened because we're so bold. We think we're bulletproof against everything.
Yeah, which is an amazing. No, that's a great point as well, because if you think about it, with all the geopolitical tension, with the trade wars, with everything that's going on right now, you would say there's a lot of obstacles and warning signs on the right. Well, not even on the horizon; they're right in front of our face right now. But yet you have this exuberance in the market, which just doesn't compute.
Yeah, I mean, absolutely. It's like again, we've stopped asking why because it's been going on for so long. And the fact of the matter is what people don't understand is that it's just like it's like a building avalanche, like a snowball just getting more and more snow. And
Mhm.
so, yeah, it has been going on for so long. But guess what's going to be getting worse and worse? The value of the dollar, the reputation of the dollar, and there's going to be a critical inflection point. And the
Mhm.
inflection point is going to be where you either save the currency or you save the market. And the consequences are going to be dire on either side. And we're right there, actually, where it's like the dollar's going to go down 90% or the market's going to go down 90%. But you're not going to be able to do both because we were so used to being able to pull those leverages of free money to stimulate the market
Mhm.
without a consequence, right? But now there is a consequence because inflation is here and it's taking root and it's here to stay. It's not just transient inflation like they like to say.
Yeah, no, absolutely. And I guess that's the thing that a lot of people, like, kind of lay people, or maybe not, like, paying that much attention, but they get told, like, the markets are roaring, they get told, like, the economy is coming back, but yet when they go do their grocery shopping or everything else, they feel poorer.
Yeah, I mean, I'm a contrarian, and if everybody says zig, I'm naturally inclined to zag, right?
Mhm.
Because it just makes too much sense that when something's all over the newspaper and all over the TV, I'm sorry, 90% of the population doesn't get rich. I mean, that's why there's a
Yeah.
small minority of people that make money. So the fact of the matter is that when you look at this compared to something like, let's say, precious metals, there's a reason why gold's been around since Jesus was walking the planet,
Mhm.
and yet less than half 1% own it. And that's simply because, guess what? If you own gold, it's a direct competition against the banking system, which is a multi-trillion-dollar system,
Mhm.
direct competition against Wall Street, with multi-trillion-dollar industry, and direct competition against the US dollar and the United States government. So you have two multi-trillion-dollar industries and the most powerful government in the world not wanting you to own something. Well, guess
Yeah.
what? You're going to have a situation where you have the secret investment hiding in plain sight.
Yeah, so make sure you have a good safe. And it's
Yeah.
well hidden. Well, listen, thanks, Brandon. This has been fascinating. All of Brandon's information will be below this video. But before we go, please do remind people about what you do.
Sure. So I'm Brandon Thor. I'm the CEO and founder of Thor Metals Group. We facilitate physical gold and silver transactions. So this is the actual physical asset. We help our clients acquire it, either with money in a bank or within an IRA or retirement plan if they so wish. So that's what we do. And if you want to get in touch with me, you can go to www.buythorgold. And that's to book an appointment, directly with me. I'm happy to chat with whoever is willing to listen to this gravelly voice for more than 5 minutes. Or you can go on our website, www.thormetalsgroup.com. And our number is 1-844-944-THOR.
Excellent. And I would encourage people to go check it out. As I said, we're in interesting times, and they could get very, as you said, they're going to get very interesting very, very quickly, and probably faster than a lot of people anticipate. So I encourage you, if you don't have gold in your portfolio, a good time to go check it out. As you said, it doesn't matter what the price was yesterday or the day before. It just matters what the price is today. And there's no time like today to get investing.
Absolutely, John. And listen, I really appreciate the opportunity to come on. And it is fascinating stuff. And I would leave you guys with this. Really, when you stop asking why, like I just said about this
Mm-hmm.
economy, start asking yourself why you do things the way you do in terms of, putting your wealth in dollars in a bank account, and when you start thinking about it and you start really thinking about it, you'll wonder that it's because of conditioning and not because
Mm-hmm.
it's the right thing to do. And that's
Yeah.
where, you're going to be open-minded and you're going to start understanding the power, precious metals have.
Yeah, great point. Thanks again, Brandon. Thank you for watching and listening.